In uncertain global economic outlook and heightened geopolitical risks, a lot of investors turn to gold to diversify and make the most out of market volatility. Although gold prices saw a sharp rise in recent times, investors should not only look at the profit opportunities, but also be aware of the risks. In this video, we explore the various risks every investor needs to consider when investing in gold. Unpredictable price swings. Gold, like other asset classes and markets, has its equal share of rises and declines in prices. Gold prices can swing sharply towards the upside and to the downside, triggered by many factors, including geopolitical events, shifts in monetary policy, inflation expectations, and market speculation. Liquidity risks. The ability of an asset to be easily purchased or sold on the market at a reasonable price is known as liquidity. An asset that has many buyers and sellers at the current market price is said to be highly liquid. In general, physical gold bars, coins, or jewelry are less liquid than, say, exchange-traded funds, ETFs, gold futures contracts, or digital gold. Depending on the type of gold investment, liquidity can vary greatly. Investors who need to quickly convert gold into cash need to take this into consideration. Storage and insurance costs. Physical gold requires secure storage to prevent theft or loss. Additional expenses, such as storage fees, insurance premiums, and transaction costs, can add up. Depending on the storage options, such as home safes, bank safe deposit boxes, or specialized private vault services, the cost will impact the net return on investment. Cash flow and opportunity cost. Holding gold does not provide regular returns when compared to asset classes, such as bonds, property, or dividends from company stocks. This is often considered the major drawback of investing in gold, as you can only gain from capital appreciation. If gold prices stay flat for long periods, especially if stock markets are doing well, this will be an opportunity cost for investors who could be invested elsewhere. Understanding your own risk tolerance. It is essential to determine your risk tolerance when you invest in gold. When you have a longer investment time horizon, you can often tolerate greater short-term price volatility, making gold a suitable asset for long-term financial goals. You will need to determine whether your primary goal is capital preservation, a hedge against inflation, or portfolio diversification. Gold can possibly fulfill all three objectives, but the allocation to gold should be aligned or consistent with your plan. Consider your personal comfort with market fluctuations. If you experience anxiety from price volatility, you might prefer smaller allocations of gold or opt for investment vehicles that offer more liquidity and lower volatility, such as a gold exchange-traded fund and digital gold instead of leveraged gold futures. How to manage and mitigate investment risks related to gold. The foremost strategy to manage investment risk is diversification. Dedicating an appropriate allocation of your total portfolio, for example, between 5% and 15% to gold, will help to serve as a source of risk reduction. Regularly review and adjust your gold allocation to make sure it aligns with your risk tolerance and investment goals. You need to be aware of market trends, shifts in the economy, and important geopolitical events that may provide indications of the possibility of changes in gold prices. It is always better to be proactive in adjusting rather than reactive after prices have moved adversely. Get bullish about learning.